So who and what is Top Down Investments? We are a real estate investment firm that specializes in identifying key properties and unlocking the hidden value. We partner with investors. They bring the capital, we bring the sweat equity. Together as a team, we tackle some pretty exciting projects, and our reputation has been built from purchasing and renovating apartment buildings, and now we're switching into the development mode for a lot of reasons that we'll describe here in this video as well. And one of our favorite men out there who had it right from the beginning, Mark Twain, buy land because they ain't making it anymore. And no matter what's happening, they're just not creating any more space. And despite what's happening in the prices and the market volatility, that is a constant that is never, ever going to change. And so historically, we agree with him that land holds its value and appreciates a ton over time. And it's all about just being in the market. And every single person will always tell you, and I wholeheartedly agree, that majority of the wealth is held in real estate, and majority of the wealthy people in this world are involved in real estate in some way, shape, or form. And utilizing real estate and leveraging it to create and enhance your returns is the best way to get ahead, in my humble opinion. So the commercial real estate industry has created some pretty fantastic opportunities for us, and I want to share a little bit about that with you as well. And our core values: we want to create and generate substantial returns for our investors and the people who believe in us and partner with us to go through the journey that we're going through, because we want to see people succeed with us. We need them, they need us. We work together, get some things done. Our vision is to become the most respected developer on Vancouver Island. And that's working with the people on Vancouver Island, like I said, to help achieve a similar and mutual goal at the end of the day, which is financial freedom through real estate. And so we want to provide access to investors that don't normally have access to the vehicles and the investments that we're involved in, and open it up to the people who are trying to create the wealth, not the ones who already have it. And that's how we do it. We add value to the relationships by enhancing the financial literacy for everybody, and teaching and educating and supporting everybody that gets involved. And that's exactly why you're here tonight, is to learn a little bit more and hopefully gain some knowledge and gain a little bit of information in these uncertain times. So without further ado, the real estate market during COVID, interesting one, because if you would have asked me at the beginning of COVID what was going to happen, I'd probably, like a lot of people, we may have felt at that time that we were heading into a recession, and that maybe the banks were going to freeze at that time and things were going to get a little crazy as far as holding on for dear life. And of course, we all know what's happened in this past couple years, and found a little video that summed it up for us. So and Ron Burgundy summed it up pretty bang on. That escalated really quickly. This was a wild ride these past couple of years, and I don't think anybody could have predicted what was going to happen. And at the end of the day, we've been subject to some pretty incredible market conditions that we haven't seen in a while, quite frankly. And this is not just in our area, but across the board. And we've seen historical low interest rates that have basically made financing things a lot easier, and the acquisition of real estate has benefited so greatly because of that. Increased disposable income, the demand for homes rose dramatically. Working remotely, of course, through the COVID was one of the biggest things I feel that drove a lot of the markets, because people were moving out of certain areas and into new ones, and they felt that the quality of life was all of a sudden more important than the actual work that they've been tied up in their entire lives. I'm just speaking from experience, because that's exactly how I felt. It's exactly what brought me out to Vancouver Island. It was the feeling of just being able to enjoy some space in the times where we were all locked down and weren't sure what was happening, right? Low inventory, that's kind of been the case all along in this market. But when people are expanding and populations are increasing and immigration is increasing and all of the things that are pushing the market in the direction it is, of course, low inventory is one of them. And from an investment standpoint, FOMO, it's of course always a reality. Everybody wants to get in on the times. You don't want to miss out on opportunities that are being presented to you. And we all want to get involved in the rise as it's happening and get caught up in the hike. And then 2 months ago, the world starts to change upside down and things start to rapidly change. The interest rates spike immediately. Everything freezes, and all of a sudden, we're looking at the exact same thing in reverse.
Boy, that escalated quickly. I mean, that really got out of hand fast.
It jumped up a notch.
It did, didn't it?
And it's funny because that is an exact representation of what happened. 2 years ago, everything starts going crazy. We live in a whirlwind. And now all of a sudden, everything is completely upside down and going in the opposite direction. And that's what creates the uncertainty. Everybody's frozen. But man, did that ever escalate quickly. The interest rates have basically tripled overnight, if you will. We don't even know where it's going to stop. Prediction is it's going to keep going up. Nobody knows what's going to happen. But man, we better just take a breath and take a minute to think about what's going on. So the new market conditions that we're facing, we've got aggressive interest rate hikes, which of course are affecting lending. They're affecting people's ability to purchase. They're affecting the fear that lives within everybody. Is it the right time to lock in? Is it not the right time? Can I still afford? There's a lot of people that were in a position to qualify for a lot of purchases, which are no longer in a position to qualify. You're going to have a lot of people that are going to be coming up for renewal in the next little while who have all been locking into interest rates over the past, 1 to 4 years. So you're going to see a lot of uncertainty and a lot of different things changing for a lot of people just in regards to that one very important thing. And of course, that affects lending. Lending's not nearly as easy to get anymore. So leveraging the assets that people weren't able to. So no wonder everything's frozen because everybody's just waiting to see where everything lies. You've got reduced disposable income. A lot of people have been affected by work and jobs and affordability, and things have been changing and shifting. It's harder to hold on to key employees. It's hard to figure out where people are going to be laying their head at the end of the day. People are moving markets. The affordability factor is still a very real thing in a lot of areas. And I think for once, it was something that was felt globally, not just in the key markets like Vancouver or Vancouver Island. I think, we know for sure nationwide that the same thing's pretty much been happening everywhere. And so the demand for homes has dropped dramatically right now just because of that freezing. So prices haven't necessarily come off just yet in a lot of areas, but the demand for those houses has definitely come off. The sales have dropped dramatically, and that's just a byproduct of people just waiting to make some decisions. Telecommuting may not be a permanent thing. Are people going back to work? Are they relocating back to where they did their jobs, where they left before? Maybe certain things are happening that are requiring everybody to uproot again. Increased inventory, of course, is going to have an effect on all the things that are happening, and the impending doom of a potential recession on the horizon. And everybody's talking about it. Everybody's looking forward and trying to look into the crystal ball and trying to determine whether or not that's a reality, whether to purchase, whether to sell, all of these things. But at the end of the day, we're just here to figure that out and talk about it a little bit more. And so let's talk about the history of real estate for a second, because it's really important to look at past information and historical data to help just understand what may be coming, right? We're never going to be able to look into the future and predict what's going to be happening there, but you can definitely look at historical data and historical trends to give you an indication of what may lie ahead so that you're ready and you're prepared when it does. So the problem with predictions, of course, is that they're just predictions. They're just based on a whole bunch of different sets of information coming from different sets of people. Case in point, Here is an ad that predicted the house price drops in BC. Dire predictions from CMHC. That is the Canadian Mortgage Housing Corporation that has all of the data and pretty much is in the know now with all of the data points across the country. And if this ad was released today, I might tend to agree with them. But if you take a look, that's an ad that was released in May 27th or on May 27th in 2020. So the beginning of COVID, the dire predictions of everything was going to crash and things were going to drop and uncertainty in the market. And at the end of the day, we all know what happened. It did the exact opposite of that. And it skyrocketed right up until this particular moment. And so just be careful about the information that you read, be careful about the information that you digest, and just absorb it, make your own opinions, suit it to your life, and make sure that it fits within your risk profile to ensure that you're making the right decision for yourself. And so this chart, this is a very, very well-known chart, and this is the Greater Vancouver average prices from 1977 until now. And you pretty much see this on the wall of every single bank office that you walk into, and you'll hear a lot of people talking about this at all different times in history. And it's just to give an indication of what the overall trends have been from the beginning of time, if you will. And everybody always asks me, is your investment safe? Is the real estate market a safe investment? Should I buy now? Should I sell now? You know, where is the comfort in knowing what's going to happen? And the same answer that I'll give you now is the same answer that I give to everybody that's ever asked me. And I believe wholeheartedly in real estate over time. If you take a period of time spanned over a minimum of 10 years, you'll pretty much see that historically the trend always winds up going up. But that doesn't mean that during certain times it isn't going to go down. And so a really good saying that is really important to remember is it's time in the market, not timing the market. It's just like stocks, right? Everybody's trying to time up or down. Do I sell? Do I buy? Where's the key factors and the key indicators to help me make that decision? That's a risky endeavor because you're never going to know. That's gambling at its finest. But if you plug in with the intention to hold on long term, this chart should give you a pretty good indication that over time, real estate only does one thing. It goes up. It never stays up, but it definitely always heads in the upward direction. And we just wanted to get a little creative with this chart because everybody kind of knows this, but it's, you know, if you look at a few different things on here, it's very interesting. And if you look at from beginning to end, and keep in mind that in 1977, the average house price in Greater Vancouver was $77,000. So obviously, you'd like to rewind the clock and say, man, I wish I would have bought everything back then because here we are. Everything's worth exponentially more. But again, nobody has that crystal ball. Just start to take action now. But if you take this map and you look at this, overall, it's a constant upward trend. But what you don't tend to see in this or break it down at an eyes level is what happens in the downtimes. Where are those points where the market does come down? Because they do. And if you overlay the spots in the market, this is what that looks like. And so this is an indication of what points in time after a peak the market goes down. And you'll see in comparison with all the times that it goes up that typically the down portion of the trend is a pretty small portion of time. Whether it's a longer period of time like back in the 90s or in mid 90s where it spanned over a 5-year period, or whether it's in 2016, 2017 where it was a smaller, shorter amount of time, the point is that after it goes down, it always comes back up. And right now we're clearly going into a down market. Things are softening. What you don't know is how long it's going to take to go down or stop going down and come back up. And that's the crystal ball that nobody has. But you do know one thing, that it's going to come back up. So I wouldn't say that now necessarily is the right time to buy, But I do know that if you do buy at any time and hold on to it long enough, it's always going to come back up. So just remember that. And the other key piece of information here that was very interesting is that everybody always looks at the end of the chart and they're just like, wow, that's an exponential spike, and it just goes up so sharply and keeps going up sharply. But if you look at the points where it does go up, the historical periods where it did go up went up drastically more from a percentage basis than they have been in recent history. For example, from 99 to 09, the market increased, the values went up 130% over that time. It was a little more gradual, yes, but in reality, it still went up 130% compared to from 18 to date. It only has gone up 46%. We say only, that's a lot, but at the end of the day, it's all a matter of perception and where you look at the market and all the indicators relative to what it is that you're looking at. And then of course you compare that to the moments in time where they've gone down, you see kind of a trend there too. Yes, they're going to come down. There's a varying percentage of how much they're going to come down, whether it's 5% or 13% or 17%. It's all going to vary depending on the time and when it starts to come back up. And we don't know. You can't see a number in the last bar there because we're living in it right now. We don't know what that number is going to go to, but we definitely know that at a certain point, it's going to start to turn. It's going to start to turn in the upward direction. And similar trends nationally. Everybody says that's Vancouver area, and so it's an exceptional market and that you can't compare the data there. And what about the areas across Canada? Well, if you look at that chart right there, that is a comparison to the average benchmark nationally. And you can see that it follows a very, very similar trend overall. And that's just the standard information that you're pretty much going to find no matter where you go. Here's a similar trend on Vancouver Island. All of the charts tend to follow approximately the same lines. And so overall, you're going to get the ups, you're going to get the downs, and it's okay to feel a little bit uncertain right now because it's an unknown time, but just have comfort in knowing that historical trends are likely going to follow, and at certain times, we're going to turn back around. So if you're caught in a situation where you may be going down in value and you were supposed to have an exit in your investment and things aren't going the way that they plan to, don't panic. Try and go back to your plan B and your plan C. Reach out for help. Look for some exit strategies that may work for you. And if they don't, just hold on, batten down the hatches, and wait for the right time for you to exit on your investment. And what about interest rates? So let's look at that for a second, because that seems to be the sort of key piece to the sky is falling aspect of this world, is that interest rates are skyrocketing. People don't know what to do. Should they lock in? Oh man, I locked in at, a variable, or I did a variable rate. Now it's going up and it's gone up a point or 2 points or what the heck ever. But you got to remember that the interest rates that we've been experiencing over the past 4 years they couldn't have gone any lower. They could have. I mean, I think we had a point to spare before it got to zero. But at the end of the day, they were absolutely the best bargain that was known in our not only recent history, but very, very long history. And this is a prime example of that. All the way back to 1940, where they were at about 5 to 6%. And we're just getting back to that today. When I bought my first house in 2021, I'm pretty sure that my interest rate on that house was, I think it was 4.5 to 4.7% at a fixed rate, 5-year term, right? 25-year AM, I think at that time. And that was a great rate, but I didn't care because I was basing the investment on the return that it was giving me. I wasn't focusing on the cost. And it's similar to a principal residence, where that's kind of the exceptional piece to this. If you're purchasing your principal residence and you're utilizing lending for that, it doesn't really matter as long as you can afford it, because your principal residence is where you're planning to stay for a very long time, and you're going to experience some ups and some downs. And it's not really about locking in at the key moment. It's just a matter of making sure that you can afford it and that you're basing your investments on that as well. And this is a really good thing, a really good piece to talk about right now, because in comparison to, performas, and when people are using projections and they're looking at the feasibility of their projects, and when a lot of investors are doing due diligence on investments, there are assumptions. You have to, because when you're using future values, you have to use assumptions. And the rule of thumb, when I took a lot of my real estate training from the good ones, the people who taught me the right lessons, was to always be ultra conservative in your projections. If the interest rate was 5% currently, the pro forma should have an 8% interest rate in there. If it was 2%, make it 6%. Like, just cover your ass. Like expenses. If the expenses in an actual investment are 15%, let's say, you don't want to use a pro forma that shows that you're going to be 14 at the end of the day, because you're just too tight. And when things do change, which they are, that's when you're going to get hit the hardest. And so the operators and the issuers out there that are using conservative projections on costs and expenses and interest rates, they're the ones that you want to hang your hat on, because they're not being overzealous and over optimistic on the future values. Because if everybody looks at today's data and the interest rates and it's like, oh, thank goodness the interest rates are at 2%, now this deal works. You know what's going to happen when they have to start paying the 5, 6, 7% interest rates that we're going to be experiencing. So just keep that in mind, because everybody wants a deal to work. I want every deal to work. Trust me, when I'm underwriting a deal, man, I want it to work really badly. And I'm willing to, be a little aggressive on certain things, but I've come to learn that it's just not doing you any favors. And if the deal just doesn't pencil out when you're trying to be conservative, that's usually a good sign to just walk away, because the good deals are out there and they do work. Another very interesting chart that I thought, might be of value here is the average household cost comparative to income. So this doesn't take into consideration cost of living per se, but housing is a big part of our cost of living, and this is how it relates. And people have long been complaining about Vancouver in general, about the affordability and about how the prices are so far out of whack to the income, and how the times are so much drastically different than they've ever been. And the reality is they're not. They're high. Don't get me wrong. They are high, but if you look at this chart, it's just starting to approach the numbers that existed in the mid-90s. And in the mid-90s, the average household cost proportionate to the income was higher than it is today. And so again, it's all relative in time and place and scenario as to where you look at the data. And the other interesting thing is, if you look at this chart, it goes down too. As soon as it hits a peak and the cost of the housing starts to exceed or get too far away from the proportionate or the proportion of income, it tends to come back down, which is kind of what feels like it's happening, because labor rates, haven't really changed much. It's hard to find good people. Housing has been out of this world, skyrocketing these past few years, and it just feels like that stretch is just too far to handle, and people are flooding out of areas that they can't afford to live because the jobs that they've been working for the past 10 years haven't changed one bit. And so, my honest opinion is we're gonna see a change. The housing prices are, it feels like they're for sure gonna come down overall, and it also feels like people are gonna have to be paid more to be able to stay in the areas where people need them to work. And the construction industry is a prime example. It's been suffering big time. You can't find good people, period. And it's hard to even get a good trade, find a trade, let alone even get a good one. And that's been affecting the construction industry and how fast things can be built and how expensive they are. And all of these things have a factor, but this was just an interesting thing. So, I don't foresee this gap continuing to expand, because it's just unsustainable. And so my prediction would be that you're probably going to see wages come up and prices come down, and this should shrink, and hopefully it does, because eventually we want everybody to be able to afford to get into real estate, and this is one of the factors that may impact that. So, multifamily assets, are they impacted the same way? And people also ask me on a regular basis, why multifamily? And I have one simple answer when people ask me that. Commercial and multifamily real estate are not affected the same way when you do have a fluctuation in the market. Residential real estate is valued based on what the market says it's worth, period. If your house is worth $1 million today and the market goes down 20%, it's worth 800 grand tomorrow. And it doesn't matter if you're renting that place out for $5,000 a month or $50,000 a month. The income has absolutely no bearing on the value that the banks are going to give it. And I learned that when I was in the residential real estate market a lot when I was younger and growing my portfolio. And man, it was tough. It was up, it was down. You could get lending today, you couldn't get it tomorrow. And you were always dependent on the cash flow that it brought in. And whether that was good or bad, it didn't really matter. You were just riding the wave and you just kind of went with the flow. Multifamily is the exact opposite. And it's not volatile because it is based on the net operating income that it generates. If you have a building that's worth $1 million today and it generates $50,000 a year in income, the market can drop 20% all at once. If the residential market tanks and it goes down 50% and that $1 million home is worth $500,000, that building worth $1 million, as long as it's still generating the $50,000 a year in revenue, it's still worth $1 million. And in fact, when you see a recession and a softening and a freeze in the market, typically the demand for apartments go up, no matter what the market is. So when the market's crashing and people are losing their homes or they're going into foreclosures or they can't afford to find a place that they need to live or they can't make the payments or qualify for the mortgage, they're looking for places to go. So they have to go to the rental market. They're forced to the rental market. And the exact same thing applies for when the market is booming. If everybody's buying their places and the market is growing and the industry is booming and trades are increasing and the demand for employees is going up, people are flooding to that market and they're looking for rentals. And you experience that even in a hot market where, people are looking for houses. So they're selling their home, they're living temporarily until they find a new place to go, they're transitioning. No matter what, they're always looking for a place to rent. And rental demand is by far the safest investment as far as I'm concerned. And that's why I focus on multifamily. The rents stabilize or continue to increase. They do not drop. And I say that in our market, okay? I'm just going to use the reference in our market because historically, and I'll show you a chart here in a minute, but historically in Vancouver, the rents have basically never gone down. And when you look at that, it basically says that the value of your building is not going to go down based on the revenue. And that's a really, really safe feeling. It's a really good feeling. And not only that, the building is actually based on the income. And so that's what the banks will give you lending on. They're not going to give you lending based on you and how much you make every year. They give it based on the building. And cap rates may worsen, but historically it's very minimal. And that the cap rates do have an effect on the value of the buildings, but they're very, I don't want to call it regulated, but they're very stable. Cap rates typically don't go up and devalue surrounding properties. It usually heads in a downward direction, which increases the value of your building. And so high inflation can cause expenses to increase. Of course, I think everybody's experienced that. And high inflation often leads to strong rent increases because as the cost of living goes up and as inflation increases and as the cost to run a building goes up, well, of course, the charge to the tenants has to go up and the revenue has to support the building because it's part of the business. And so we pulled a chart that was, basically a grid with a whole bunch of different styles of houses and rental units spanned over a 60-year period. And there's a whole bunch of numbers of all the different rents in all the different housing categories over this period of time. And we just simplified it right before this webinar and put it into that chart right there. Vancouver, British Columbia, average apartment rents. You do not see a part of that chart that goes down. Not once. And so if I'm basing my investment on anything and I'm going to hang my hat on one piece of information based on what we do, that is it right there. And that's a pretty darn good thing to represent why we believe so strongly in multifamily real estate. And so what are we doing? And everyone's asking, what are you doing? And we're still making calls and we're raising capital for our deals and we're out, slugging it out like everybody else, building our business, looking for the next deal, wondering what we're going to be doing. And at the end of the day, we are doing the exact same thing. It's business as usual because we believe so strongly about the business that we're in. Land development never stops. It might slow down and it might go, it might get more expensive in different areas and the product type might change and the demand might change, but it just never stops. And even if it does, the land ain't going anywhere. And the need for housing doesn't go away. And the one thing that you don't really realize while the market is freezing and values are fluctuating and all of these different things are happening, the one thing that's still continuing to happen that nobody really talks about at a high level is the increase in population. That is constantly going up. There are always people coming into the areas of high quality of life where people want to live close to jobs. And on Vancouver Island, we have the luxury of being in one of those places. And we're talking massive, like between 100 to 150,000 people per year coming into the Lower Mainland and Vancouver combined. And that's just what they have on paper. That's not really including temporary housing or vacations or people that are, coming in for student or for school, students coming in for school. All of those things are driving the demand up. And whether things are moving or not, those people are still coming. And all of our current projects are in the planning stage. And I'm really happy, to be honest, that we're not in development per se right now, because with the cost of everything always increasing and the supply chains always being in question and labor being such a hard thing to nail down, I'm thankful we're not in the middle of actual construction right now, but all of our projects are still geared towards the rezoning and the increasing of density for purpose-built rentals, so that when the time is right, we will be building housing for purpose-built rentals because we know the demand is still there and it will continue to be there. And we believe we're in the perfect place at the perfect time. And that's what I continually want to pound into your head, is to focus on the things that the banks focus on, which are the assets that are based on the revenue that they generate. And so our projects should all be ready when the market correction has ended, if it even happens. I mean, we keep talking about this and we keep talking about whether or not the market's going to crash or whether the recession's coming. And everybody, if you ask, like, it feels like it is. And maybe it is. Maybe there's impending doom right around the corner. Maybe it's next week. Maybe it's, in December of this year. Maybe it's the spring of next year. Or maybe we get surprised and the banks come back down, slash our interest rates, and just like the beginning of COVID, everything reverses and everything carries on just like it was beforehand. Nobody knows. But just plan for the worst. You can hope for the best, but plan for the worst. And at the end of the day, planning for the worst for us is planning on the housing that people are going to need. And so getting involved in our projects on Vancouver Island is an opportunity that every single person has. And I want to talk about some of our deals here in detail, because it not only will share with you some of the projects that we're involved in, but it'll give you some insight as to what we're going through in these current times, and in hopes of sharing that information with you if you're going through your projects and maybe some of the questions that you're asking yourself and what moves you should be making. And so if you're an investor looking to invest in other people's deals, then there's a certain criteria that you have to abide by, of course, or that the issuer has to abide by. And if you're somebody out there doing your own deals and looking for people to invest in your deals, then there is criteria that you need to abide by. And these are all very important things that you need to understand, because in today's world, with all the money floating around and all the real estate as hot as it is, the securities are 100% focused on making sure that people are doing business the right way. And so accredited investors, just so everybody knows, if you're an accredited investor, is an individual with at least $1 million in net financial assets, which is cash and securities. individuals earning a $200,000 a year salary or $300,000 combined with their spouse, or $5 million in net assets. That's just your total net assets, including real estate and cash and securities. Accredited investors have the luxury of investing wherever and whenever they want into any deal that they're presented with. Non-accredited investors are very limited to where they can invest and who they can invest in. And you got to be careful where you invest your money, especially in these times, and you want to make sure that you're doing extra due diligence now to make sure that your money's going into the right place. But that shouldn't stop you from continuing to invest in the things that are going to have future growth in the right areas. And so the project that we've been working on the most here over the past 6 to 8 months is our land assembly in downtown Duncan. And this is still an extremely valuable project for us because these properties are intended to be rezoned to high density for the purpose of constructing and building purpose-built rental buildings. Each one of those sites that you see is an assembly of residential houses right in the heart of downtown Duncan. That's 2 separate building sites that we're going to have in a very strong up and coming area. There's 5 key properties we identified last year. The whole area around here is targeted for redevelopment, and that's something that you want to focus on when you're investing. The whole part about where to invest, how to invest, why to invest, what's the right market, is it going to go up, is it going to go down, is a very general term that can't be answered for all areas at once. You have to know exactly where you're investing, why you're investing there. And we know we've been doing the research in Duncan for the past 2 years since we landed here. And we know that there is an OCP from the city that provides great information on where they plan to increase the density and support development. And we're very aware of that, and we're very in the know on that information. And we've been doing our due diligence, and these properties weren't just a guess, they were targeted. And so when you're doing your due diligence on properties and investments, you have to know that stuff. And being close to amenities is a great thing for any investment. Of course, you always talk about that. This is literally 1 block away from being in the downtown core. It's right across the highway. You've got grocery stores right around you. You've got access to public transit, all of the things that support residential housing. And it's a perfect multifamily building spot. And we anticipate more density in the surrounding area that is going to support all of the stuff that we're doing. And these properties are already zoned. They're currently zoned medium density, which means that the city already supports a 4-story maximum building on these properties. And we're looking to increase the density to a 6-story building. And we also know that the city of Duncan has released their draft OCP and has these properties already listed as high density in their draft OCP. Now, that's not a slam dunk, it's not certain, but we've been in communication with them throughout the entire process, and we know that there's a very good chance that we're going to be able to get support for the buildings that we're going after right now. And so that limits our risk as well from a high level standpoint. The area, these are all things that, you want to know where you're investing, how you're investing. The Lower Mainland and Vancouver Island, there's not a lot of areas that people don't want to be, but you want to look for convenient locations, because the biggest thing that you got to take into consideration when you're looking at investment is you might think it's a good area, but at the end of the day, there's one person, most important person, that you really need to convince it's a good area. And that's the people lending you money. Because the lenders are the ones that determine values and level of risk. And they're going to be the ones making sure that you're investing in the right area that has the amenities, that gives you them the strength and security to lend on. And so all of these things are important. Close to bus routes, there's recreational facilities. And we're fortunate to be in a small town here in Duncan in the Cowichan Valley because it has a lot of amenities in a very small area. And so it's very easy to get around. And I like it for that reason. I mean, I commute from my house 10 minutes out of town, and I really don't spend more than 10 to 15 minutes driving anywhere in the area. That works really well for me, so I know that it works really well for people that are coming here. Parks, walking trails, river, numerous restaurants, all of the good things that an investment has to offer, these have it nice and close. And so this is just to give you a little snapshot. The actual development that we're looking at doing We're looking at getting a rezone complete inside a 24-month time frame, which is really conservative because the typical rezoning process in this area takes between 6 to 8 months, probably up to 12, just because it's getting so busy. But at the end of the day, this is the 4-story building that the properties are already zoned for. So this is kind of our worst case scenario for these properties, and we're looking to put 2 more on top of that. Targeting additional properties on the street has been a goal from the beginning, and market conditions are going to continue to be monitored, and we're going to be looking for multiple other properties and projects that align very similar to this one. And the exit opportunity after this one is to sell it to a developer or ultimately build these buildings ourselves. And again, we like either option because one's going to be an exit with profit for our investors, and the other one is going to be the rollover into constructing a building that is going to be a legacy for everybody for the rest of their life, with a building that's going to pay down and appreciate forever. So we've got some numbers here. I won't get too nitty gritty with this. It's hard to follow, but you guys will all get a copy of this so you can review this info. And of course, you can get it from us at any time. We'd love to walk through, but we've got one parcel that's 27,000 square feet. We've got another parcel that's almost 22,000. That's a total land area of almost 50,000 square feet. Land cost of 4 million, rezoning cost of 1 million, total of 5. And the capital that we're looking for and that we have been is about $3 million. And we're about 60% there right now. And I don't foresee us needing that whole amount. And so we're just getting to the tail end of wrapping this up. We'd love to get more people involved. And this is an anticipated hold period of 24 months. And that clock started in January of this year. So we're already almost 6 months into this project. And we're getting ready to submit our application here within the next couple of months. Per unit land value after rezone, we're projecting is $35,000 per unit with a 185 unit build between both sites. And the total return that we're projecting is approximately 36% over the 2-year period. And that's a 60-40 split of profit with the investors, 60% to the investors, 40% to us. And that's after we pay an 8% annual pref rate as well. So the investors on the deal get 8% annually before we even carve up the profit at the end, and then they get 60% of that number as well. Some other projects that we have, which again, we feel really good about because they're all in the infancy stage of planning and getting ready to execute for ultimate construction. We've got the 2 building in Duncan. We've got a 150 acre subdivision, which right now is currently zoned for 2.5 acre lots. And we're assembling a plan right now and looking at the ability to increase the density there, potentially to approximately 50 residential sites in a Bearland strata. Really exciting. That's just a few minutes up the road from my house in a very sought after area. Super exciting. We've got a Nanaimo property of 14 acres, which we just closed on a few months ago. 14 acre development that's currently residential and is in the OCP for high density. That is one of our most exciting up and coming projects that we haven't released yet, but we've been talking a lot about it. But that's going to see anywhere from 400 to 800 units potentially. And that's within the bylaws that currently exist on that property. It's a very exciting project. And what's not on here is the 6 acres of industrial land that we have fully funded and are in the process of design stage for the ultimate construction of about 100,000 square feet of commercial industrial property there. So if you have any questions, you can go to our website, you can register on our website, you'll receive announcements and updates about every single thing that's coming up in the future here. Looks like we have some comments here. Thank you for your attention, everybody. We'll get to the questions right now. Yeah, so we will. All right, so yeah, so if you guys have any questions, we're looking at the Q&A right now. Got this right here, just seeing a couple pop up. I know I tend to go through this information pretty fast and it's a lot to digest, so we are going to be releasing the recording to everybody and we'll be sending that out for everybody to review. I do want to apologize. I know that a lot of people registered last week and we just had some internal difficulties to make that happen. So thank you for making it to this one. And I know a bunch of people are looking for the recording after we send this out. But I don't see any questions coming in. So it looks like we've got everything answered. Do want to say thank you. I'll hold on here for another couple seconds just in case there is any. But you guys know how to get a hold of us. Oh, we got a hand up there. So I've got a hand up from Lauren. You got to use the Q&A, Lauren. We're not doing the mic. So if you want to type in the question box there, I can answer it that way. Think you're coming through with the question there. Yeah, but as everybody knows, you guys can get a hold of us, go register. We're going to have tons of updates on a lot of the stuff we got going on, and there's going to be some crazy things happening over this next little while. And I do want everybody to know that we are going to continue to look for opportunities over the next little while. We're not stopping the search for good deals. We want everybody to know that when we do find a deal, we are going to be releasing it to our database first and to our current investor pool. And we're going to be, we're anticipating if things keep going in the direction they're going, there's going to be some great opportunities, and we're not scared to be attacking those opportunities when they come. So just keep an eye out for all that stuff. Lauren, I don't see a question coming through here. You had your hand up, but not sure if you have one. Yeah, and you know what? You can just email me. Our email information should be on the webinar. Mine is guy@topdowninvestments.com. If anybody wants to email me directly, that's all good. I don't see anything coming through here. So you guys know how to get a hold of us. I won't keep you any longer. I know it's late back east. And I just want to say thank you to every single person for coming out here. It's always a pleasure to be sharing the information. We get lots of great feedback about these. So we're going to keep doing them. And yeah, get a hold of us. Check us out at the website. Just keep an eye on the future opportunities we got coming up because they're going to be very exciting. So everybody have a very good night. It was great talking to you all again. And we'll see you next time, okay? Bye for now.